Good morning. Well, it's 11 a.m. in Los Angeles. Might be different times where everyone else is out there. Thanks for joining us. My name is Kevin Harris. I'm a professor of sociology at UCLA. I'm a co-director of the Center for Social Theory and Comparative History. On behalf of my fellow directors, Robert Brenner and Chi-Kwan Lee, I'm very excited to host this panel discussion today on the politics of finance. We've been doing sessions this quarter at UCLA focusing on political economy of inflation, which was an event we held a couple of weeks ago with Isabella Weber and Tim Barker. Today we have some excellent presentations by Ben Braun and discussion by Sarah Quinn, who I will introduce shortly. And I wanted to alert those watching that we have another event planned in a few weeks with Michael McCarthy, who's a fellow at the Berkman Center on democratizing finance. So it's kind of I consider a trilogy for our center for this quarter. So let me introduce our main presenter today, as well as our discussant. We at the center have been following Ben Braun's work for a long time. He's not only quite interesting analyst of contemporary financial institutions, but also very prolific. So he's been writing quite a lot recently. And I think we'll put a link in the chat for those watching for a piece he did last year at Phenomenal World, which is kind of a précis of what he's working on now. And Ben is a political scientist at the Max Planck Institute for the Study of Society. He specializes in international and comparative political economy, and most notably focuses on the politics of central banking and asset manager capitalism. So he's going to present his work for about 35 minutes. And then we're going to have a discussion by a fellow sociologist, Sarah Quinn, who's associate professor of sociology at the University of Washington. And she's also an affiliate at the Harry Bridges Center for Labor Studies. She's the author of a tremendous book from 2019, American Bonds: How Credit Markets Shaped a Nation, which won two highly prestigious book awards, the Viviana Zeller Award for Best Book in Economic Sociology and the Alice Amden Best Book Award from the Society of Socioeconomics. And Sarah's going to be commenting on Ben's work and presentation and expanding the discussion. As you're watching, if you have questions for Ben or Sarah, you can send it to us in the chat, but you can also, I think more importantly, in the Q&A session, if you're watching now, raise your digital hand and we will turn on we'll allow you to turn on your microphone and your camera, and you can ask the question yourself. And for the rest of those watching on YouTube, you can check out future talks from our center at the center website. So thanks to Ron and Vani for the behind-the-scenes technical administration of this panel, and let me turn it over to Ben Braun.
Hi, everyone. Thank you so much for the invitation to speak. I'm very excited about that invitation, and I'll share my screen now. All right. Now, can you see the right slides or the notes?
I think you should swap displays.
Could you tell me on audio?
We can see both your slides and your notes.
All right, then let me swap it. Now it should work.
There we go.
Perfect. All right, so I have the slightly daunting task of talking about the political economy of ownership and control, which I will try to do through the lens of what I have been calling asset manager capitalism. I'll be going quite quickly, but I hope that with the visual support, it will be okay, and then happy to answer any questions, of course, in the Q&A. So here's the agenda. I will quickly talk about what I'm talking about when we talk about finance, about different conceptions of financialization, And then we will talk about the role of finance in the economy and how it has changed over time and how that has led to a different mode of structural power and what the asset managers have to do with that. So what is finance? In the standard view, the function in standard view in political economy, but also in economic history and in economics, the main function of finance is the financing of firms to allocate scarce financial capital to its most productive uses in the economy. The primary institutional forms of financial intermediation are banking and capital markets. And the structural power of finance is a function of its ability to threaten to exit firms, sectors, or entire countries. And this structural power has been researched, of course, first and foremost in comparative and international political economy, which is the field that I work in mostly. Now, I also want to say a couple of things about financialization, because it's a contested topic and it's never quite clear what is meant. Therefore, so there's a provocative question here. Is the history of financialization 50 years long, or has it been going on for 500 years? So the standard version of the story of financialization, of course, says it's a phenomenon of the last half century that started sometimes in the 70s, or as Sarah Quinn in some of her impressive work shows, actually maybe even earlier in the 60s. But it is, the story here is one of the exhaustion of the Fordist growth model. And then the cause is regulatory and monetary policies that unleash finance. Then one could say, well, there is actually a longer, or the current configuration has a lot of similarities with a configuration that existed 100 years ago, which Rudolf Hilferding called finance capital. So here, well, we'll come to that later. This is basically my perspective here. And then there is, of course, a literature that people at the center know a lot more about than I. And I put the Arrighi book here, which really spells this out the most. And in this perspective, financialization is a recurring phenomenon in the long history of capitalism. And whenever what we might today call a growth model exhausts itself, this leads to a long and protracted process of financialization, oligarchization, and so on. My perspective on finance is influenced by the third perspective and by the second perspective, but of course I'm talking about the same period as the first perspective. So that's why I put all this here, just for orientation. Now, one could say that the standard view of finance is a view that is correct in the early phase of a cycle of accumulation, whereas in the late phase, but that would require that we believe that we're in a late phase. But anyway, in a phase when a lot of financial wealth has accumulated, in the language of Piketty, when there is a high wealth to income ratio, then the function of finance becomes wealth preservation rather than financing. The dominant form is asset management rather than financing by banks and capital markets. And the source of the structural power of finance then changes, and control becomes more important. Ownership and control become more important, and today even diversified ownership, which is somewhat different from the configuration that Hilferding described. But I will spell that out in greater detail in the following half hour. So, but that's the frame for my talk today. Now, the core argument is that here in this part is that the dependence of the non-financial sector on financing, on money borrowed from the financial sector, has declined. So let's look at this in some empirical detail, and I'll show you a few charts. I will show you some charts to support the argument that the idea that the non-financial sector relies on external financing, financial capital to finance investment, no longer captures how the economy works, at least not the US economy, but the same could be said for other advanced economies, but I'm showing you data for the US. So Exhibit A shows the result of some fairly complicated calculations that are based on a methodology used by some economists, and I have taken this from Till van Triek mostly. And it shows that the vast majority of corporate investment is financed from internal funds. That's the bluish green area that is retained profits. The orange colored category equity shows that the stock market has not been a source of net financing for the corporate sector since 1970. And indeed, its contribution turned negative in the 1980s. Perhaps the most remarkable thing here is that even traditional bank loans have made a negative contribution since 1990. That's the pink part, loans. Now, here I show you banks, the declining relative size of the banking sector in the first panel as a holder of financial assets in the United States. The share of banks of total financial asset holdings has declined from 50% in 1945 to 25% today. The second panel shows that commercial and industrial loans, the orange part, is only a tiny part of bank lending today and has also declined quite considerably. Whereas real estate loans, like Braun, have seen the largest increase. Now, what else can we say about finance, the role of finance in the US today? Exhibit C. Here, the first panel shows the declining importance, the growth of the financial sector in the value added share of US GDP. So the standard measure for the size of the financial sector, even though, of course, measuring the contribution of finance to the economy in these terms is very questionable and has been criticized, rightly so, but it's still a good proxy for just how much of the value added is sort of skimmed off the top by finance. And you see that this has increased from just below 4% in the 60s to more than 8% today. And the biggest increase, so banking and insurance was almost all banking and insurance in 1963. And since then, the share of security, so asset management, is really what has increased the most, I think fivefold at least. The right-hand panel shows the net interest, shows that even for banks, net interest income is not the whole picture. And in the longer perspective, this data would show that would show an even larger increase of non-interest income, so income from fees, including asset management fees from banks. So this is just to show that even when we talk about banks, a significant part of the income, more than one third today, is from fees, not from traditional interest income from lending. Now, finally, the last exhibit here is we can, when we began by looking at the degree to which corporations finance investment from with borrowed money from the financial sector. And there was a category loans, which we looked at, bank loans, and there was a category equities, which has also turned negative. And this is what we see here. We zoom in on the equities part. So net corporate equity issuance since 1996. Many of you will be familiar with this chart. It shows that even though gross issuance of equities has gone up, this is in nominal dollar terms, so that this is also very much a valuation effect, of course, this increase. But more significant is the solid black line, which shows that the net issuance really has become more and more negative as more stocks have been retired via M&As and via stock repurchases by corporations than have been issued. So the stock market very much has become a mechanism to ferret capital out of the corporate sector, or at least out of the listed corporate sector. And this sector has shrunk, of course, as more and more firms have delisted in the US, often by buyouts by private equity firms, or now by single billionaires with support from Wall Street. Okay, so to recap, banks are a shrinking part of the financial system today. The dependence of corporations on external financing has declined, and financing has become relatively less important as a source of income for the financial sector. Now, all of this creates a problem for the conventional conception of exit as a chief source of financial sector power. And from a political economy perspective, and I've been working on a paper on this, which a draft of this is online, but it's a work in progress. From a political economy perspective, this is really important because there is a large literature on the structural power of finance that does emphasize the exit scenario in various ways. In general, the structural power of capital, or simply business, is theorized to reside in the fact that in a capitalist economy, growth depends on private investment, of course, and if capitalists don't invest, that generally spells trouble for politicians. Now, although structural power has several dimensions, in the context of international political economy, the most important mechanism here is exit. This is captured well by the concept of a capital mobility hypothesis, according to which the greater the ability of liquid financial capital to move across borders, the greater the structural power of its owners vis-a-vis governments, but also vis-a-vis other private economic actors, such as labor and local business. With this focus on capital mobility comes a focus on financial capital, which, unlike fixed capital, tends to have much better exit option. And this is epitomized, of course, by the figure of the impatient institutional investor, which has played such an important role in the political economy literature. This exit-based theory of structural power of finance, I think, is sound, but it does run into trouble at a time when a lot of indicators point towards exit having become much more difficult for financial actors. And what I showed you before, the declining dependence of finance on external of the corporate sector on external financing is one part of that story. But as we shall see, the way in which the sheer size of today's shareholders and the way in which they invest this money via index tracking funds adds a whole second dimension to this decline of exit. But first of all, let's look at this through a broader theoretical lens and talk about what structural power, how we can make sense of structural power of finance today that operates primarily through control and is complicated by the fact that share ownership is diversified. When we talk about institutional capital pools and their growth today, and about the rise of asset managers and the increased footprint in the non-financial economy, then we really talk about a configuration akin to the one that prevailed in the United States, but also in Germany, of course, around 1900, more than 100 years ago. And this is what Rudolf Hilferding famously analyzed as finance capital. Now, for Hilferding, finance was not just a source of financing industry, but a means of reorganizing industry. And financial capitalists pursued this quite aggressively, as they do today, one could say, mostly evidenced, or most spectacularly evidenced by the private equity industry, of course, and by the buyout model. But at the time, at Hilferding's time, capitalists whose profits exceeded what they could or wished to reinvest took the money to the bank. This caused the banking sector to lend ever larger sums to corporations in order to then earn interest for their depositors. When, as a result, banks acquired a, quote, permanent interest in corporations, that is, when they lost their exit option, they faced the problem of control. Corporations had to be closely watched and, quote, controlled by the bank. In the US and in Germany, banks' role in corporate governance was then geared towards minimizing competition, maximizing profits, and thus the ability of corporations to service their debts. Debt servicing capacity was, if you will, the equivalent of shareholder value today. So in essence, Hilferding argued that the concentration of finance capital should strengthen the power of wealth owners by facilitating coordination among fewer and more homogeneous agents. So it is this perspective that I think can really help us make sense of the continued structural power of finance at a time when the exit option has, for various reasons, declined quite dramatically. And this perspective, of course, has always been around. There has been not so much in mainstream political economy, mainstream as in comparative and international political economy, on corporate governance and so on, but it has been around in regulation theory, and it has also been around, of course, in the literature in the US, in US sociology and the corporate elite, the inner circle, and so on and so forth, which was a literature about ways of maintaining control at a time when, institutional shareholders were not available to exercise this control through very high or very large shareholder blocks, but when basically in a Burley and Means world where shareholders were relatively small and not very powerful, this literature described an inner circle that managed to exercise power through other means. Anyway, I think today we can just unearth Hilferding and work with this concept. However, I mean, there is a reason why I prefer the term asset manager capitalism over finance capital, or rather two reasons. There are two twists. The first twist is that whereas the dominant financial institutions of Hilferding's day and age were banks, today they are asset managers. And we'll get back to those. The second twist is that unlike under finance capital conditions, today's asset managers combine substantial control and diversification. And this combination is really unique and without precedent in financial history, because until very recently, control has always come at the cost of diversification. Diversification is, of course, a key theme in financial history, and the expansion of the universe of financial intermediaries and instruments that are available to owners of financial wealth is maybe the main theme of financial history of the last 200 years or so. And I put here one example, the example of Genoese creditors to the Spanish crown in the 16th century, whose structural power was limited, one could say, by the fact that they could only extend non-tradable loans to one highly unreliable borrower. So these are two very big restrictions: non-tradable loans and a very limited market on the demand side for their money. Now, if you look at late 19th century Britain, for example, still a while ago, but here the gentry and industrialists all alike were already in a much better position. They could, for example, choose between government debt and domestic equities when it came to financial investing, money in financial assets. And they could even gain exposure to foreign securities by buying shares in the Foreign and Colonial Investment Trust, which was, in a way, the first mutual fund, and whose history is a fascinating case study in the imperial origins of the mutual fund model. But that's a different story. It's time to move on to the more mundane world of contemporary asset manager capitalism and ask the question, what is BlackRock? So at the risk of boring some of you, I think it's important that I just bring everyone on the same page. So here I show you a stylized representation of the equity investment chain, which looks pretty much like that all over the world. Some of the firms that I name check here, all of the firms that I name check here operate globally. Essentially, what happened over the last 70 years is that the emergence of new financial intermediaries has made this investment chain longer. So in the post-war moment, there was basically nothing in the middle of this investment chain, or very little. And in the Burly and Means world, households held all the corporate equities. Then, over ensuing decades, the pension funds sector in particular grew, and more broadly, institutional investors grew, which also include endowments, of course, in the US, and insurers also belong in this category, and sovereign wealth funds, of course. And then since the 1980s, 1990s, I described this in my book chapter on asset manager capitalism as a corporate governance regime, how this came about. You had an increasing shift, or rather, there was a second chain, a second link in this chain emerged, the asset management sector, which grew because these institutional investors increasingly delegated the investment of their money to these third-party asset managers for various reasons. And this continues very much today. This development has not stopped since. For example, today there is an article in the Financial Times that talks about the rise of the outsourced chief investment officer model. So increasingly, for example, large corporate pension plans, an airline was cited as an example, outsource the management of all of their portfolio to BlackRock and other asset managers. So this is the latest and fastest growing model of this outsourcing of institutional investor money to these asset managers. And the point is, or why this matters, is that asset managers are many times larger. The largest asset managers are many times larger than the largest institutional investors. So yeah, as this chain lengthened, the institutions that are the immediate holders of shares and bonds grew larger. Now here is BlackRock's latest financial statement from the first quarter of 2022. BlackRock today manages $10 trillion US. Reading from left to right, you can see that, for example, BlackRock manages money mainly for institutional investors. Of those, US pension funds are by far the largest group, of course, but this includes institutional investors from all over the world. And you can also see in the style columns and product type, in the style columns, that the investment style is overwhelmingly what is commonly called passive investment funds. That is, BlackRock invests investor money via index funds and exchange traded funds, which are also index tracking funds. And you can see that BlackRock is, half of this money is invested in equities and then a big chunk in bonds, and then increasingly BlackRock is also moving into alternatives. Only three, so basically private equity and commodities and so on, and real estate. So this is a recent development. Now, what does the rise of BlackRock have to do with the decline of the exit option? Here are two indicators of declining exit options for US domestic equity funds. You can see on the left-hand side the outflow from active mutual funds. That's the negative part at the bottom, $2 trillion since 2011. And the same amount of money has moved into these index tracking funds, ETFs and index funds. So this is a huge shift into these non-actively traded investment funds. And you can see on the right-hand side the declining share of domestic equity fund portfolios that are turned over the course of one calendar year. So this was 3 quarters and is now close to only 1 quarter of the portfolio that is turned over. And I believe this does not include ETFs, which are not, but I'm not entirely sure at the moment. But I think this is just, mutual funds, active and index mutual funds. All right, then, so this is one reason why exit options decline, one facet of this second cluster of reasons why the exit option declines under asset manager capitalism. This is the other one. I show you data for Germany, not for the US, just to show you that this is not purely a US phenomenon, but that BlackRock and Vanguard, the big two asset managers, are also very large investors in the headline index of the German stock market, the DAX. And you can see here that, in most of these companies, the big two have a combined share of more than 10%, and in quite a few in the vicinity of 15%, and in very few even almost 20% combined share. And the point here is you cannot, even if this were not money invested by index funds, you cannot divest in individual firms when you hold a 10% stake, because this will exercise a lot of pressure on the stock price, and then your investors will suffer. So this is an additional reason why these new dominant shareholders are not the institutional investors that the corporate governance and political economy literatures have generally assumed in the US, in the UK, as the dominant investors, but also increasingly elsewhere. So short-term oriented, actively investing US pension funds, no, this is a very different investment model and share ownership landscape. All right, so now you can maybe see a little better of what this structure of the financial system looks like today. And now in the remaining 5 minutes, I want to quickly say a few things about asset manager capitalism as a corporate governance regime, and how it is different or maybe similar from preceding regimes. And this table shows the evolution of the corporate governance regime in the US from basically, the hill-fitting model of finance capitalism until today. So you can read this from left to right, and you have the main hallmarks of each regime. There are four categories. The concentration of ownership, which was high under finance capitalism and is high again today. So there is a lot of similarity there. The control of shareholders was strong then and is potentially strong today. And it's certainly higher today than under the shareholder primacy regime in which pension funds were the main shareholders. But then there is also the variable portfolio diversification. And here, arguably, portfolio diversification of the robber barons, which is not a ill-fitting term, I don't think, but which is a common term to refer to the individuals and families who controlled basically, this investment model in the US. So their portfolios were not highly diversified. These were individuals and families who controlled their corporate empires and maybe held a monopoly in one sector, such as steel or whatever, but they were not diversified, and not across borders and not even across sectors. And so here, asset manager capitalism is very different. And therefore, the final category also, there's a big difference there, because the interest of these asset managers in individual portfolio firms is, I would say, very low. And it is lower than the interest in the performance of individual firms of the institutional investors that dominated under the classic shareholder primacy regime of the 1990s and 2000s. And so that creates all kinds of theoretical conundrums and questions that are very much under discussion today. So just as an entry point into this discussion, the main, I think, the most intriguing implication of asset manager capitalism is the promise of universal ownership. Diversification means that today's dominant shareholders hold the entire market portfolio. These universal owners should, in principle, take the long view and curb the negative externalities from activities of listed companies. And the main example here are, of course, carbon or greenhouse gas emissions. And there is a lot of discussion of whether BlackRock and Vanguard are going to somehow save us from the climate emergency, but there is very little evidence so far, and people have studied this. All the evidence points in the direction that BlackRock and Vanguard have been uniquely almost management-friendly in their voting behavior and have not supported ESG-motivated, so environmental, social, and governance-related shareholder proposals, and so on. We don't have time to go into that, but I think this is fairly established at this point. This may be changing under the pressure from civil society, but also regulators. But so far, this has not been the case. So Larry Fink, the CEO of BlackRock, has long positioned himself as a champion of this logic of universal ownership. Long-term thinking is definitely his favorite phrase. But long-term is true, because these are investors that cannot sell and do not want to sell individual shares in individual companies, but they have not acted in the way that universal ownership theory says they should be acting. Now, what's the reason? What are the reasons for that? Just very briefly, and then I'll conclude. There are various conflicts of interest, to put it mildly, that happen at various levels, from micro to meso to macro. And I've listed the four most important here. One is that at the firm level, asset managers, and especially large index fund firms, simply lack the monetary or profit incentive to invest in monitoring and monitoring capacity. They would need hundreds, if not thousands of people to do that. And until recently, they have had only a handful, and today a few dozen people who do this. But yeah, these people are highly paid, and the benefits that accrue from monitoring portfolio companies are reaped by everyone, and maybe even more active investors than by BlackRock. So that's not a good business proposition, maybe. More importantly, maybe asset managers also compete for corporate pension plans. So they really, as I just explained, and they really have no interest in overly alienating corporate management who control these pension pots often. Then at the sector level, there is the little sister, if you will, of universal ownership, which is common ownership. The same shareholders, BlackRock, Vanguard, State Street, are the largest shareholders in all the companies in any given sector, say airlines or banks. In the agenda-setting papers by Azar et al. That have looked at this, among others. And so there is an incentive in these industries for anti-competitive behavior when really the shareholders are not betting on one company out competing the others on price, but basically have an interest in maximum profit at the sector level. Of course, this is in a way the logic of finance capital. And it's a little interesting that I have not found a single Hilferding reference in the common ownership literature, which is a literature in financial economics. The politics of maximizing assets under management is another issue at the macro level. So for BlackRock, much more important than what individual firms in their portfolio do is the aggregate level of asset prices. They have a fee-based business model, so asset managers have an interest in aggregate asset price inflation, if you will, because 0.1% of $1,000 is less than 0.1% of $2,000. These fees are levied on the current market valuation, not the money paid into the fund originally by the investor. And then, of course, the universal ownership logic also has a problem because shareholders are not society, are not the economy. So universal asset managers are the representative of shareholders, not of society as a whole. And as you all know, the distribution of shareholdings in the US and elsewhere is extremely unequal. I show this here in the left-hand panel. You can see that the top 10%, the top 1% of the wealth distribution hold half of all corporate equities and mutual fund shares, and the top 10% hold 90%. And then pension entitlements, which are largely invested in shares, are a little less unequally distributed, but the bottom 50% still are, the bottom 50% are not shareholders at all. Okay, so to conclude, finance capital is back. Let's talk about Hilferding more. The financial sector power is increasingly based on exit, but not on exit, but on control. However, there are at least two twists. Investors, the main shareholders today are diversified, fully diversified. And it's not banks anymore, as in Hilferding's day, but asset management companies, which have a very different business model, and so require some new thinking in that regard. How have asset managers wielded their structural power that derives from control and from their diversified investment position? That is something that maybe we can address in the Q&A. I would say that BlackRock has perfected the art of navigating the narrowing corridor between climate-conscious Democrats and anti-mainstream finance Republicans. But yeah, if people are interested, I'm happy to explain what I mean by this later. I'll stop here and look forward to what Sarah will say. Thank you.
All right, thanks, Ben. That's fantastic. We did just put a link in the chat of a kind of easy to read piece on Phenomenal World
which is with Adrian Buller, my co-author on this and another project.
Okay, so I still see a shared screen, so I'm having a little bit of double vision. Maybe there we go. Okay. All right. So let's move to Sarah, Professor Quinn, with some comments. And then for those individuals who want to ask a question in the Q&A, raise your digital hand, and then we'll call on you and you can turn on your video and ask Ben and Sarah your question yourself. So Sarah, take it away.
Hi. Thank you for having me, first of all, and thank you, Ben, for this paper. I've been a fan of your work for so long now, and I love what you're doing here with exit voice dynamics. It's really the paper that this talk is based on is a bantamweight of a paper. It's short, it's like small, and it's fleet, but it packs a huge punch. And it gives us a ton to discuss and to think about. So as the discussant, I want to make sure to leave plenty of time, but I'll talk about some of the things that I'm most excited about with this paper and a few questions I have. So one of the strong claims of this paper has to do with how mundane corporate control is in this regime of asset manager capitalism. What comes across in the paper is that their main goal is to kind of keep the field stable, to make sure the goose that's giving them the golden eggs of fees keeps doing what it's doing. So they have lots of power that they don't necessarily exercise, making them, we might think of them as like a Democratic Party of corporate governance regimes. Their goal is to avoid regulation often by not kind of offending, this part at the end in the conclusion where he talks about kind of threading the needle between the Democrats and the kind of emergent kind of anti-financial stance on Republicans. And this part actually reminded me a bit of Paget and Ansell's work on robust action. They're really working on how to hide their position and speak from both sides of their mouth and try to deflect attention. The paper writes, and I quote, "To the extent that asset managers have wielded their control-based structural power, they have done so to reinforce the hallmarks of the shareholder value regime," end quote. So this brings me to my first question, which is how aware are the companies, the kind of keepers of the old regime, how aware are they of this? A lot of the magic of capital flight is always in the threat, is always in the kind of rhetoric of it, as opposed to it being fully enacted all the time. I'm thinking in a different kind of political context. I'm thinking of Christabel Young's work showing that millionaire tax flight doesn't really happen, but that doesn't stop that claim from being used consistently to roll back attempts to tax millionaires. So it's true that kind of the lack of exit likely kind of derails the credibility of kind of threats of exit. But it seems to me there's potentially a lot of space between the decline of that threat and how that threat is actually felt or experienced among companies. I have a similar question about control as well. If we're talking about corporate governance, a lot of the magic of control, I imagine, is in the threat of it as opposed to the actual doing of it. So I'm wondering kind of what you've come across or you're thinking about how corporations and corporate managers are understanding this new moment of asset manager capitalism and the threats they face, how they are orienting to it, and if and how this is changing what they're doing. Yeah. In a way, there's this like great paradox at the heart of the paper where, there's this new group that has all this power and that is so loath to use the power that the old regime is left with a great deal of power anyway. A last kind of question along these lines is where you think the limits of this might be. I mean, are the asset managers just fully trapped in this strategy of diversification so much that they really are so profoundly constrained, or are there points or things that you see that would be too constrained?
Sarah, can you
My
repeat that?
next set of questions has to do.
Oh, can you repeat?
Yeah,
We lost a few seconds. Just repeat that last point, please.
Sure. I mean, I'm basically asking for what are the conditions under which the asset managers might overcome their reticence and actually exercise this control that they have? Are there none? Are they very extreme? I mean, once that happens, are we effectively in a new regime? It's kind of a scope conditions question.
Okay, thank you. All right, Ben, do you want to take some of those on, and then maybe we'll move over to the Q&A.
Sarah, were you done?
I had a couple more things, but I also don't mind.
Go ahead, Sarah. Go ahead. Sorry.
Okay. All right, I'll go through quickly. So my next question has to do with the less mundane world of political control, because while you have the lack of exit of, while there's constrained exit, but hyper control in corporate governance, and when we're talking about the US in a post-Citizens United world, arguably this is a moment in history where capital flight of the financial class in politics is especially powerful. Or it's certainly not where we see a loss of exit. So in addition to thinking about the politics of inflated assets, this I think opens up space for further talk about kind of the intra-class politics we're seeing and how capital flight and threats of capital flight is playing a role in the kind of Republican push against financial control on the far right. The next question I had is, I'm just going to kind of, I'll go with this last point. One of the things that really came home to me when reading this paper is the extent to which, when we're talking about separation of ownership and control in the firm, that this was always also about risk too. And what we see kind of shooting through all these regimes that you're walking us through in the paper is that fights over ownership and control are also being kind of, there's a through thread of increasingly sophisticated ways of rearranging risks and shooting off risks. So if diversification strategies that are the central kind of organizing logic of this regime are kind of organizing the logic of these index funds and the electronically traded funds. We also have the rise of kind of securitization, which is shearing off risks. And what comes clear is like the triumph of fees as a way of collecting rents, also as the kind of uber risk avoidance strategy. In addition to kind of looking at control over monetary policy, I'm wondering though if we should be thinking more about influence with kind of regulatory control and court battles over the rules and the property rights that allow this to be locked in. I mean, if we look at Burleigh Means, half the book is about these court battles that are defining these rights. So I wonder if kind of there's maybe more going on there if you have more thoughts about what's going on there. And I'll I'll stop there, but I loved the paper, and I'm so excited about this work that you're doing.
Okay, thanks. Sorry for interrupting.
No
We're
problem.
having some very mild, very mild technical hiccups. But Ben, maybe you can take on some of these questions on the political side more, and then we can take some questions.
Okay, thank you, Sarah. Thank you so much. I was extremely happy when I learned that you'd be discussant. Couldn't have wished for a better one. Yeah, okay, so I won't respond to all of these points now, just to leave enough time for Q&A, but then I'm sure that we'll get back to them with the audience questions. So on the more political questions, I mean, your point about capital flight in politics being a thing in the US, I think, if I understood you correctly, is extremely astute. And I must say, I have never thought about making this link, of course. And I think it's a very attractive lens of looking at this. To the at the same time as it's become more difficult for investors to withdraw their investments from, let's say, individual large countries, and that extends to the stock market of those countries and the corporate and the sovereign bonds of those countries, because you cannot not hold U.S. Treasuries if you're a large asset manager, and you also cannot not hold Japanese sovereign bonds, for example, and you also cannot avoid these country stock markets. So, at the same time, of course, the influence of money in U.S. politics specifically has greatly increased. To completely incredible levels, especially from a non-US perspective. And so, yes, I completely agree. And there's no research that I've seen on lobbying lobbying and political spending by the asset management industry, but I'm sure it's being conducted as we speak, because but I haven't seen it. I would be very interested. And then your point about, shouldn't we be looking more about at regulatory struggles and court battles? Absolutely. This is definitely not my specialty, and I'm not an expert. I can just forcefully agree that the regulatory politics is much more important for BlackRock than corporate governance. And it's in a way, it's fascinating, because this is something that the entire field of corporate governance, which is a huge field, a huge industry, is not really prepared to look at it this way, because, well, it's a field organized around corporate governance. But suddenly we're in a world where, for the largest and most powerful shareholders, corporate governance in a investor company dyad relationship kind of way is really not the most important thing, not by a big margin. And so the same is true, of course, for other types of asset managers, and there I can give you an example. So for private equity funds, they are engaged in, I think, a very important and serious, or in two battles that are related. One is to open up private equity investment for individual retirement savings in 401k plans and IRAs in the US. I think in both. I'm not entirely sure. It's a very complicated landscape, difficult to understand sometimes for me from outside. But that is one. This is obviously a very large pot of retirement money that's not invested by the large Taft-Hartley pension funds or public pension funds that already invest in private equity. But the industry would like to access also the individual retirement savings, which so far has not been possible. So there's a regulatory battle for this money. At the same time, now I think the controller of New York State or City, I'm not sure, is campaigning to, someone, I think someone in the audience will know this better, in the state parliament has introduced legislation, I think, that would make it compulsory for pension funds to disclose all the details of their contracts and of the fees they pay to alternative asset managers, which can be very high and which has been highly politicized issue. So these kinds of battles are ongoing, and yeah, the stakes for Wall Street are extremely high. And so I can only, yes, agree with you that is where political economists and economic sociologists really should be looking. Thank you so much, Sarah.
All right, thanks. So
I'll stop here, but there were other points, but I'll try to get back to them when there are audience questions that go in a similar direction.
Sure. So from Neil Foltz. Neil, can you turn you're welcome to turn your camera and your audio mic and ask the question yourself. If not, we can go oh, here. Hi, Neil.
Hello?
Yeah, go ahead.
Okay, great. Yeah, so in our student newspaper, they just ran an op-ed pointing out that the UCLA endowment has underperformed for 5 years or a decade or so, and suggested that we reinvest in index funds or ETFs. Can you, I don't know, provide a reaction to that? It seems like with a university fund, there's some extra complications versus just, trying to get a better return, right?
Okay.
Do I respond right away?
Yeah, sure. Yeah. So Neil, you're basically talking about the UCLA endowment started in the 80s, and you kind of trailed off that it's been underperforming, and then this might be related to the overall investment strategy.
Right, exactly. So, are there extra, or a public university run by the state, should that endowment be investing in these index funds and giving up this control like you talk about? Are there extra issues other than if we do this, we get an extra 3% a year or whatever?
Okay.
Yeah, thank you very much for this question. I'm not going to share my screen again, but I have looked at the endowment data and the asset allocation by US university endowments. And it is really fascinating because endowments over $1 billion, so all the big ones, that's the largest group in this data set that you can look at separately, have more than 50% of their assets are allocated to alternative investments. So there's very little plain vanilla mutual fund, stock funds and bond funds that these endowments invest, and this a lot of it is via private equity funds, hedge funds, venture capital funds, and then direct investments, maybe in some cases in land and so on. And of course, these alternative asset managers are extremely expensive. They have the famous 2 and 20 business model, or at least had in the past. That's now sometimes up for negotiation with large institutional investors, whereby it's a 2% fee on the assets under management and then a 20% fee on any capital gains made for the beneficial owner. So they take a cut of that gain too. And then there is lots of anecdotal evidence, lots of reporting in various left-leaning, especially outlets in the US, that shows that pension funds and endowments have often, especially pension funds, have not done well. you can also read a lot about the largest endowments having done extremely well out of this. The so-called Yale model, which has been followed by all the other large endowments, is this model. But yeah, that is one side of this. The other side is that there has been a huge debate, obviously, in the US pension fund world about whether pension funds, especially pension funds, should be investing in the alternative asset management sector, which is the most, these are the high return, high risk models, and also the most predatory investment strategies out there. Leveraged buyouts. There are very few leveraged buyouts in which the excess return does not somehow come from labor. And labor, of course, is who is being represented and whose money is invested by pension funds. So that discussion could also apply, of course, to endowments. And I haven't seen how that has played out in the student newspapers. What I know is mainly divestment from fossil, divestment. These discussions have historically at Harvard and elsewhere, and I guess UCLA also, been divestment themed from the causes of the 70s to climate change today. And I think a broader case could be made, of course, more similar to the reasoning in the pension fund debates, and I assume that they are. What are the broader societal implications of these investments, and is this really in line with our values as students and faculty, and so on and so forth.
Okay, Rohan, I see you have a question.
Hi, Ben. Thanks so much for this. And thank you, Sarah, for your great remarks and questions. I had a couple questions. One was just about maybe a simple question about the equity investment chain. Why has it lengthened? Is that a result of increasing financial specialization? Is it some sort of financial specialization and then opportunity hoarding, or ways to manage risk? Like why have there become increasingly? Why has the chain lengthened? And I just wonder whether there then becomes more room for other people in the future to, emerge in this chain and possibly disrupt the current arrangement. And second, as Sarah had mentioned, there's all this control, but it's not necessarily being exercised. On the flip side, I wonder then, does discipline via exit, does it only exist for peripheral countries? And if so, what are the implications of that? Thanks.
Thank you so much, Rohan. Excellent questions. Why has the investment chain lengthened? It's a good question. I would say it's basically just the way of financial development, that as financial systems develop and capital markets develop, you get specialized actors, and in the asset management world specifically, it's just very inefficient, or it used to be, at least, very inefficient for individuals to invest their savings individually via brokers at their banks, and then try to vote their shares, having no clue what was going on, of course, in their portfolio companies. So there is something to be said that is an inefficient system. Of course, the technical reasons for why that was an inefficient system have largely gone away. And interestingly, that's another very interesting development, harking back to what Sarah was saying about regulatory battles and discussions, is that BlackRock has been, I think it was BlackRock, is currently toying with the idea and is partly already implementing it, of letting their investors, and I think so for only institutional investors, vote their shares again themselves, which would be the most elegant way, and it had been proposed by some legal scholars already a few years ago. It would be a very elegant way of BlackRock evading, or a safety valve for some of the regulatory pressure that's been piling on BlackRock, to say, look, yes, we hold the shares, but we're voting fewer and fewer of those. We're giving those voting rights back. So far, the only institutions that had retained their voting rights when investing via BlackRock and other asset managers were really the largest public pension funds, who had the capacity to vote their own shares and have arrangements that allowed for this. But of course, technically, in terms of technology, this is very can be done pretty easily today, and you don't have to go all the way to the blockchain. You don't have to go all the way down the blockchain, so to speak, to see that this has changed potentially. But which also speaks to your final sub question there. Will other actors emerge? Well, according to the crypto world, they're going to land in your backyard any day now. But prophecy has failed already a couple of times now, I think. And then the second question, discipline, and does it only apply to, I think, basically not the most advanced economies with the largest capital markets that absorb all this capital, but for basically 90% of countries on Earth. And yes, this is a very important point that I didn't have time to establish or to discuss. I had taken out that slide, so I'm grateful you bring up this point, because yes, exit is very much, if you're familiar with the concept of the global financial cycle, which is a concept, term coined by Helene Ray, an international macroeconomist, a few years ago, and which has gained a lot of traction since in international macro and finance, is the idea that especially in the years up to the financial crisis, and then a little bit less since then, capital flows have become highly synchronized across the world. And the single most important factor that determines capital flows is not what an individual country and government does in terms of, following the Washington consensus and all the doing the right things, which were, of course, not the right things often for domestic populations, but doing the right things from the IMF's point of view and from international investors' point of view was not enough to prevent sudden hot money inflows and then sudden hot money outflows, because, the Fed raises interest rates, 100 countries see sudden capital outflows back towards the core of the international financial system and into US securities. And so discipline does very much continue, discipline via exit does very much continue to exist in large parts of the world. Interestingly, the rise of these very large asset managers contributes to this, let's say, declining degree of discretion with which this discipline is being exercised, because yes, BlackRock's risk model, besides it's a risk off time now because of what was in the latest minutes of the US Federal Reserve FOMC meeting. And so across all of our funds, we just reallocate assets towards financial core assets. And so the rise of the actors that I describe or focus on, very much reinforces this logic of the global financial cycle. And so discipline is not necessarily exercised by BlackRock vis-a-vis individual countries and governments, only in extreme cases when there is default. But in the day-to-day, it's very much based on constructions such as BRICS and frontier markets and so on.
All right, we have, thanks for that. We have Sam Weeks with that question. Sam.
Hi, everyone. Thanks to Ben and Sarah, for Ben for his presentation, Sarah for her comments. My question is about something that's of research interest to me personally, but I think is part of this conversation, and that's offshore financial centers and tax havens. And I'm wondering how these are used differently from this interface from shareholder value in the 80s and aughts, from the 80s to the aughts, to asset manager capitalism of 2010s. And it seems to me that offshore financial centers and tax havens are central to the question of exit, in particular with regards to political developments. But now that the question of exit is less significant, what would be the role going forward for tax havens and offshore financial centers? Thanks.
Thank you, Sam, for the question. It's a very intriguing point because, of course, the exit via offshore havens is very much still available and open. And in many ways, maybe, at least until very recently, has been more open than ever before. Now there are all kinds of leaks, and now there are asset seizures of Russian oligarchs and so on, which may contribute to this recent the risk landscape for these offshore jurisdictions. But in general, the exit or what could be escaped by these offshore centers, of course, is taxation first and foremost, transparency, and then eventually taxation. So you could hold assets there if you were a high net worth individual that were sheltered by various legal constructions from taxation, or hidden even from any tax authorities. And so that is one way of exiting. Then, I mean, still, the assets that are held from those offshore jurisdictions are then just the normal financial assets issued in the onshore world, stocks, bonds, bank deposits, because these are the only assets available. It's not like the money goes there and then invests in British Virgin Islands bonds. It's British bonds that are and stocks that are held there. And then, of course, hedge funds are registered in the Caymans and so on, but they are investing in onshore assets in the US and elsewhere. So in that sense, I think, I would say it's really exit from the, let's say, the tax authorities, but it doesn't so much play into, of course, in the 70s, let's say up to the 70s, it's a different story, but you started your story in the 80s. But if we go back to the 60s and the 70s, or the Bretton Woods world, let's say 50s, 60s even, then the Eurodollar system and the Eurodollar market, which was the offshore part of the financial system, that is how, at that time, the offshore world was how capital could exit, when in the onshore world, there were capital controls and exit was very, very difficult. So maybe, it's an important addition maybe to my answer.
I'm gonna ask a question, and also I want to let Sarah also chime in, because while it's very clear from the data, from your talk, Ben, that passive investment is kind of the key strategy of these like huge asset management firms. Active investment is not too small a share still. So there's actually, quite a high level of active investment. Less so Vanguard, I imagine, than BlackRock, which is in the public eye as massive owners and managers of real estate, both residential and commercial, and various scandals therein. And so I want to push you on the active side. Does the active investment strategies of these huge asset management firms differ at all from the 1980s or the aughts? In that, is it more aggressive? Is it in danger of after inopportune scandal or two of invoking the ire of some part of the U.S. Political spectrum, as Sarah was alluding to? In fact, so are they going to, given this like increasing role and attention towards these firms, these asset management firms, are they actually incentivized to become more and more passive? And I also want to ask Sarah to chime in on anything that's said. And also, maybe do you have any even more additionally astute political analysis of this today?
Sarah, do you want to go first?
Yeah, no, you can go first.
No.
Who are you? Okay, fine. I'm gathering my thoughts. I think the thing that's been spinning through my mind too is this, from this discussion that we had earlier about kind of exit. I guess one thought I have is to kind of clarify that that if the game has shifted for asset managers to have that they have less exit in the market itself because there's such an abundance of capital, that capital flight is in itself kind of not as if they've kind of conceded exit in that place, but the new game is to set a general context for asset inflation and the kinds of returns that they want. Their increased capital exit in the political sphere is the thing that allows them to thread that needle so well. It is the thing that allows them to go to this other place and threaten to take away the money of the people who would control them. Then they don't have to actually come out and then offend the people in the business sphere, because all of the action can happen subterraneously. And even like publicly, they don't have to necessarily say what they want, right? They can just do it through these funding mechanisms and constantly use the threat of their own ability as a class, and not in an organized way. It's not concentrated in that way, but use that ability. And I think this gets to this kind of political question, which I think I was hinting at, but maybe not saying so clearly. But in each regime, like if we're talking about this as a political economy, any regime generates resistance and kind of counter groups moving against it. And we can see this, coming up in a few ways. On one hand, we have like a mention of crypto, which not as large at all as it wants to be, but certainly a vibrant political movement against the concentration of power of capital. You see it in, I think we're seeing kind of the rise of unions, like kind of a new surge in unions, and their awareness of kind of targeting pension funds. But we also see this other thing happening on the right, and here I'm thinking about the question of I'm like pulling up my notes. Melinda Cooper's work. Yeah, which is, so what we actually are happening on the far right is because they are not getting what they want out of these like asset manager, the kind of the dominant capital, is that they're actually moving to these kind of more extreme family funded what she calls a kind of a small business politics that's mounting an attack. So I think some of what's interesting is we're seeing all these attacks against this corporate power, and I'm kind of wondering how you're thinking about it, which is of course like a terribly vague question. But I will say, like, this is the thing that I'm now like circling in my head as I'm thinking about your paper, is like the nature of the various political movements against this. It doesn't really answer the question about active capital necessarily, but it is.
But it adds to it, and I'm glad you bring up Melinda Cooper's recent piece in Dissent, I think it was.
Yeah.
Where she talks about the rift between basically the public corporation economy that I focused on here and the privately owned economy, which comes with its own branch of Wall Street, basically, or which is private finance, private equity, and other forms. And this does then, this does allow me, I think, to say something about your question of, or maybe Kevin's question about active managers and how does their role differ from the 1980s and 1990s. I won't talk so much about active mutual fund managers, active mutual funds, because, well, one thing is they are not so active. There's this phenomenon of closet indexing, whereby even nominally active mutual funds are highly diversified and often basically very much look like an index fund if you look inside, because they hold so many shares and try to stick closely to whatever the benchmark is that they are tracking in order to limit their downside risk of massively underperforming that benchmark. That's just a side note. But really, when we talk about active capital, I think we can talk about hedge funds on the one hand and private equity funds on the other hand. And hedge funds, active hedge funds have been around for a while, and they buy into companies and then launch campaigns to change maybe a director or two, or just take influence on strategic management decisions. And these activist investors are still around. You all know their names. They're very rich and manage a lot of money. And I think not so much has changed there, except one thing, which is that when they do one of these campaigns, who do they call first? It's BlackRock and Vanguard and State Street, because when it comes to a campaign that actually depends on a voting outcome at the annual meeting, then these are the swing votes. Increasingly. And so that is one way in which these two worlds interact. The other part is private equity. And of course, private equity has gone through the roof in many ways. And buyouts are still a thing. Although even there, I think increasingly private equity is too large to just focus on buyouts. There aren't enough buyouts of listed companies that are, because asset or stock market valuations are extremely high in the US, not so much in the UK and elsewhere, but in the US for sure. And so increasingly you get these roll-up models of private equity, where they buy veterinary clinics or local newspapers or for-profit schools and independent or local ones, maybe local independent ones or local mini empires, and then combine them into national chains and then relist them on the stock market or sell them to a different private owner. And so there, let's say the landscape of actively managed capital, financial capital, has very much evolved and intensified. But private equity is much larger and can do a lot more than in the 1980s and 1990s, including, of course, in the non-corporate sector. So the largest real estate owner is not actually BlackRock, but Blackstone, the private equity company. And then this is also the main rift. I completely agree with Melinda Cooper there that if you look at the partisan alignment, the public company investors, the plain vanilla asset managers, are middle of the road, classic Wall Street, slightly Democrat leaning, but when the rubber hits the road, certain issues are more important than others. And whereas private capital, hedge funds and private equity is really a large part of these industries, is very much Republican aligned, and there are a lot of prominent figures that are actively quite active in the political spending scene, and so that is an interesting, I would say, development. This also links to the macro picture. BlackRock wants stability and high asset valuations. They want that the right person is at the Fed. They don't want any cranks to be appointed to the Fed. So, I don't know what they did behind the scenes when Trump was making serious moves to appoint cranks to the Fed, but I'm sure they were very much against it. Whereas, hedge funders, they don't necessarily always want stability. They thrive on chaos, and these cliches, there is some truth to that. Not total chaos, of course, but volatility is good for them, but BlackRock does not want volatility. So in many dimensions, you can see really there is a clear difference between these two, let's say, types of asset managers.
Okay, all right, thanks, Ben. All right, well, I think it's a good time to stop, and I really appreciate Ben Braun and Sarah Quinn joining us here digitally for a kind of quarter series of panels on political economy of finance inflation. And I encourage everyone watching to check out the Center's website, Center for Social Theory and Comparative History, and get on the listserv. That's where we announce future talks. And thanks to Bob Brenner and Chin-Kwan Lee for co-directing it. And thanks to Rohan Advani for organizing it and asking an excellent question about the periphery, the rest of us out there. So thanks to all, and we'll see you next time.